When you're buying a home and getting a mortgage, a lender is going to likely need to order an appraisal to determine that what you're paying for that home is what the property is actually worth. But there are times when those appraisals come in lower than what you've agreed to pay for the home. What do? I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and today I'm here to help you. Now, a low appraisal is something that we do see from time to time, and it typically stems back, unfortunately, from the realtor not doing the best job of negotiating the price of a property for their client. Had they pulled comps, meaning comparable sales, prior to submitting the offer or negotiating a price, they would know what the property value is. But unfortunately, there are times where it's just a bad appraisal. So what happens when we get a low appraised value? Well, I'm gonna give you some of the options that we can follow for that. So I'm gonna run you through a real life scenario of how this is handled. Let's just say you're buying a property, call it purchase price is $400,000, and you're borrowing 80% of this, right? So you're putting down 20%. So your loan amount is $320,000. Now, the way lenders operate is we lend on the lower of the appraised value or the purchase price. So what I mean by that is, let's just say that it was a $400,000 purchase, like we said, right here, 400,000. An appraisal takes place. We'll say AV, appraised value, comes in at 410,000. Pretty awesome, 10,000 more than you're paying, right? However, in this scenario, we lend on the 400,000 because it's lower. Like I said, the lower of the purchase price or the appraised value. Here's another scenario. Purchase price, 400,000. Appraised value, 390,000. What do I lend on? 390,000, right? The lower of the purchase price or the appraised value. Like I said in the beginning of the video, what do you do in this scenario, right? This scenario is great. You're getting the property for less than it's worth. But what do you do in a scenario where the appraisal came in $10,000 low in this example? Well, the first thing that should happen is your lender should reach out to the buyer's agent, who should then reach out to the listing agent, right? Buyer's agent represents you as the buyer. Listing agent represents the seller of the property. So reach out to the buyer's agent. And I always say, hey, do you have any comparable sales that were not used in the appraisal report that you would like to provide so we can go back and we can ask the appraiser to reconsider the value? That's step one. We can provide as a lender up to 3 comparable sales that were not used in the report. We have to explain why we feel those are better sales or better comparables to the subject property and why they should be used over the ones that were used by the appraiser. Maybe the square footage is closer in size. Maybe the bed and bath count's closer. Maybe it was a more recent sale than the one that was used in the appraisal. Maybe it's closer in distance. Right? Those are all things that need to be considered. Now, let's just say there aren't comparable sales that took place that support the value more so than those that were used. Maybe there are some sort of defects in the report itself. Maybe the appraiser listed a comparable as being a 4-bedroom, 3-bath home, but is actually a 3-bedroom, 2-bath home, right? Or listed the square footage as 3,000 square feet, but it's really only 2,500 square feet, right? Those can be deficiencies in the report which affect the outcome or the value that the appraiser gave. So that's something else that can be appealed. But we go to the realtor, ask them to provide the information. Assuming they do, a lender can submit a reconsideration of value document to the appraiser, give them typically 48 hours to respond and come back by either changing the value, utilizing the information provided, or give an explanation as to why the information they already used in the report is better than the information that was provided on the appeal or the reconsideration of value. So that's step one. I would say maybe 10% of the time, the appraiser will change the value based on the reconsideration. And keep in mind, the appraiser does this for a living. That's their profession. It's very likely that what they provided as far as the values is accurate to what the market dictates and what the comparables that were used in the report dictate as far as the value is concerned. So let's just say they will not change the value. They are sticking with 390 and it's 400,000 as your contract price. So what's another option after you've tried that? Well, you would then go back or have your buyer's agent representing you go back to the listing agent and say, hey, my buyer is not willing to pay more than what the property appraised for. Please speak to your seller and see if they're willing to lower the price of the property down to the appraised value. We've already tried appealing it. The appraiser will not change it. Here's why. This is the value of the property. In best case scenario, the seller agrees to lower the price to the appraised value. Everything gets reduced, and now you move forward at $390,000 in this example. But what if they're not willing to reduce the price? What if maybe they're willing to meet in the middle, right? Maybe they come back and say, hey, we can't go down to 390. We're just not in a position to do that. We're willing to go down to 395. So what happens? Because if they agree to pay, let's just say, the new sales price, right? So that's your new purchase price, but appraised value is still 390, right? And I said earlier that we'll lend on the lower of the purchase price or the appraised value. Well, in this scenario, the appraised value is still lower than the purchase price. So what would happen? Well, first thing you can do is you can cover the $5,000 shortage out of pocket, right? Number one, you're short $5,000, right? 395 minus 390 is $5,000. That's where I got this number from. You can pay that at closing out of pocket. We'll lend based on the 390, call it a day. You're walking into the property, coming out of pocket $5,000 more than you initially anticipated. Seems pretty simple. But what if you don't want to do that? What if you don't want to have an extra $5,000 that you have to bring to closing? What's an alternative to that? Well, if you're this buyer who's putting down 20%, well, you have some room there because we can lend to you putting less than 20% down. So what I would suggest in that scenario, if you don't want to physically come out of pocket with the extra $5,000, you were happy with the amount of money you needed for closing, what I would do is I would just change your loan to value, right? Loan to value is the percentage of the purchase price that you're borrowing. So it was 80% because we were doing $320,000 on a $400,000 purchase. But if now we're doing $320,000, we want to keep your same loan amount, but on a $395 purchase, our new loan to value is 81%, just above that, but let's call it 81%. So what would that do? Well, that would mean that you have to pay a little bit of mortgage insurance, not much because you're barely over 80%, but it allows you to keep your loan amount the same, which in turn would keep the amount of money you need at closing the same, and pay a little bit of monthly mortgage insurance in your monthly payment in order to make it work without having to come out of pocket at closing with an additional penny. Now, this can work at multiple numbers, but I'm just showing in this example what would have happened at the 5,000. Had they not agreed in this scenario to go lower than the 400,000, let's just say appraised at 390, we said it was 400,000. They're not willing to sell for less than 400,000. Well, in this example, if we took the 400,000, we would go ahead and there's a $10,000 difference, right? Between 390 and 400,000. You don't want to have to come out of pocket for that. Well, same thing applies. We would take 320,000 divided by 390,000 rather than 395,000, right? We're talking about this into this, right? And that would have been 82% loan to value, right? It's only 2% above. You're paying mortgage insurance. You're not coming out of pocket with anything additional. Everything as far as your cash to close remains the same, right? So just because a property appraises low, it doesn't necessarily kill the deal. Now, don't get me wrong. There could be scenarios where maybe you were only doing a 3% down payment, or you were doing a small down payment plus the seller was giving you money toward your closing costs. And if you're not familiar with what I mean by that, check out my video on seller concessions and seller contributions. But in those scenarios, it's more likely that the deal could go sideways or fall apart. But if you're already putting a decent sized down payment, you have some wiggle room there. It really comes down to if you're comfortable paying over the appraised value for the property, if the seller is unwilling to reduce the price down to what it appraises for. So these are just a few scenarios you can come through. Obviously, there's a multitude of ways this can work out, but that's the general process you should expect to follow and a lender should follow if and when a property appraises low. For more videos like this one in all things mortgage and real estate, make sure to subscribe to this channel. And if you have questions about your own scenario, make sure to leave a comment below. I do reply to 100% of the comments left on my videos.